Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
All right. Welcome to another episode of Retirement Rescue Radio. I'm your host, Nate Miller, and today we're going to be talking about taxes again. So actually, I talk about taxes a lot on these podcasts, and there's always just a little bit of a different flavor or a different angle that we take each time. And today, we're going to go over five tax strategies that every retiree should use. And there are tons of tax strategies out there. I mean, we're not going to go through every single one that we utilize in our practice. That would take far too long. I don't know if I have enough podcast episodes that we could do that. But you know what? There's at least a handful that show up quite a bit and should be a part of I'll say almost, not everybody's, but almost, depending on everybody's situation, plan. And in some form or fashion, these might be part of everyone's plan. And so let's go through this. I mean, there could be, as many as 65 different strategies that we could utilize in retirement and tax strategies. But the five that we're going to go through, one is Roth Conversions. Two will be a conversion from an IRA to an IUL. What is an IUL? It is an indexed universal life policy. Three could be tax loss harvesting. And four would be something that we call in the industry, we just call it a QCD. It stands for Qualified Charitable Deduction. A donor advised fund. I have a little bit on each one of these in the past. And so what I'm going to do today is go over a little bit about what each one of them is and the benefits, I want to say the benefits that you as the retiree can get by doing or utilizing these different tax strategies. When we start combining different strategies, they become even more powerful. And again, we won't have time to go through every single one of the combinations that we can utilize with all these different strategies, but we're going to give you a few ideas of what you could do. And if this is the type of planning that you would like to see for your own situation, then go ahead and reach out to us. We're going to make our calendar available through a link. We'll have 15 minutes. You can hop on a phone call with us, express some of your concerns, maybe your situation, what you would like to save on taxes, and we'll see if we can help. So first thing we're going to go through here is the Roth Conversion. So the Roth Conversion, what is a Roth Conversion first off? I think a lot of people know what a Roth Conversion is, but it's always nice to have, a definition here. So Roth Conversion, that is when you take an IRA, some of those qualified dollars. So that would be something that you got a deduction for when you contributed to that account. It might have been a 401k or a 403b originally, maybe a 457. But when you rolled it out of your company plan, it became an IRA. And so now what we're going to do is we're going to convert that IRA to a Roth IRA. And the reason is because when we pull IRA money out, we have to be taxed on it in whatever tax bracket we are at. It's going to be basically the highest tax bracket because those dollars pretty much come out last. And so that is why we do this, is to get it into a tax-free bucket so that all of the growth going forward, we're not going to be taxed on. That's the reason that we want to do this, because what we have been told is that we're going to be in a lower tax bracket when we retire. And for the vast majority of our clients, that is not the case. Most of them are in the same, if not even higher tax bracket in some cases. And so if what we were told isn't what's going to happen, we have to find out some type of an exit plan without paying too much unnecessary tax. And Roth Conversion could be one of those strategies. So benefits of a Roth is once you get the IRA money into a Roth, now all of the growth on those dollars inside the Roth IRA are now tax-free forever. They are tax-free on the growth. You don't have to take any required minimum distributions on them, and they will pass tax-free to your children as well. Now, they still have to take it out within that 10-year time frame, but they won't have to pay any tax on it. Also, while you are living, If you pull any money out of your Roth IRA, not only is it tax-free, but it's not going to increase any of the tax that you're going to have to pay on your Social Security either. There are a lot of things that do that, even tax-free, and I'm going to put quotes around the tax-free interest from like municipal bonds. So that actually does increase the tax that you pay on Social Security. So while the interest itself from the municipal bonds might not be taxable, it can actually create more Social Security to become taxable. So therefore, that is indirectly taxable. If you pull money out of a Roth IRA, it is income tax-free, and it does not increase the Social Security tax either. So it is completely tax-free there. Now, the next one would be very similar to the Roth conversion. It would be converting from an IRA to an IUL, the Index Universal Life. Well, Nate, why would you want to do that? Why would you want to convert or use your IRA funds to go into a life policy? Aren't you giving up access to all of those funds? No, actually, a lot of the same benefits of the Roth IRA are still present with the IRA to IUL conversion. So it's still all growth is still going to be tax-free. No required minimum distributions on any of the cash value inside those life insurance policies. You could take money out tax-free to live on in retirement as well if you wanted to through policy loans against the cash value. And so that could be some way of in getting some additional money to come in to pay for certain things in retirement. It also does not increase the tax on Social Security. It will also go tax-free to your kids, and had the benefit of there is no 10-year rule for life insurance proceeds. And so the kids don't have to worry about taking that out within 10 years. They can do whatever they want to with it. You also have, obviously, the leveraged death benefit. And what do I mean by leveraged? Well, let's say you get the policy and a few years in, you pass away. Well, whatever that death benefit amount is, for your account to have grown to that amount in just a few short years, the chances are slim to none that would be able to happen. So it has that leveraged death benefit to go to your heirs that would be more than what you actually had been able to convert into it at that time. So that's definitely an added benefit. And another benefit is you can actually tap into that death benefit to pay for long-term care expenses if you have any type of a long-term care incident happen. If you need help in the home, if you need an assisted living, or if you even go into a full-blown nursing home, it will help at any one of those scenarios. So that's another benefit of going into an IUL policy as opposed to a Roth IRA. Both of them are good. It just depends on what somebody's situation, on which one of those would work better for each one. There's also tax loss harvesting. So this is going to go outside. So this would be number 3, tax loss harvesting. This is going to be, no longer are we talking about qualified dollars like an IRA or a Roth. We're talking about non-qualified dollars. So money that you may have put into a brokerage account, or maybe it was called an individual account, even a joint account, or maybe it's even a trust-owned account. So in any of those cases, the money that you put in is not taxed because it's already been taxed. You're using after-tax dollars to fund these accounts. There's no limits on how much you can fund each year. You don't have to be working in order to contribute to these. So unlike an IRA and a Roth, you have to have earned income to contribute to an IRA or a Roth throughout a year, not to convert, but to contribute. But these non-qualified individual accounts or joint accounts, there's no limit on what you can contribute to it. And you don't actually have to have job income. So if your pension income or you're taking required minimum distributions, your Social Security, whatever, if all of that ends up being more than what you actually need, you can reinvest into these after-tax accounts. And then you'll pay tax on the growth of those accounts, but not the actual original amount that goes in. We call that original amount your basis. So you won't pay tax on your basis again, only the growth. And so if you have a bad year, hey, this is 2022 and right now the market is still down. So if you've had a down year, you might actually be able to sell some positions strategically. This is not always this is not always what you should do. You shouldn't always sell stuff in a down market. Obviously, that's because that's the opposite way of making money in the market, right? Is buying high and selling low. So that's not always what you want to do. But for strategic reasons, maybe if you're rebalancing and you want to get rid of some at a loss, so that way you've got a loss showing up on your tax return. And on your tax return, you can only deduct about $3,000 per year of loss. So let's say someone like in 2008, it was a really bad year. For whatever reason, they ended up selling a lot of their positions to where maybe they had a $30,000 loss over that year. And now they can only deduct $3,000 per year. So that's $30,000 that they can carry forward, actually 27, right? Because they get $3,000 in the first year. And then they're going to carry that $27,000 over $3,000 each year for however many years, right? And so what that could do down the road is if you have a year where you've got a lot of gains, but maybe you would like to sell out of some of those positions, well, you can use that capital loss carry forward, right? And actually make that a wash sale. So let's say you do that when you've got maybe $24,000 worth of loss that you're still carrying forward. Well, let's say there's a really good year and you actually want to reset your basis without having to pay any tax on it. So you sell $24,000 worth of gain, and then you use that $24,000 that you're carrying forward to wash that out. So you actually don't owe any extra tax for selling at a gain now. So that's what tax loss harvesting can be used for. Now, the next one will be what we call QCDs, qualified charitable deductions. And these are something that you can do to lower your tax liability if you are charitably inclined once you hit age 70 and a half. And so it used to be 70 and a half is when you started your required minimum distributions. Now that's 72, but you can still do these qualified charitable deductions at age 70 and a half. Now, I feel like it has a bigger impact once you actually do hit retired minimum distribution age of 72. So we'll go into that. So what that means, let's say your total required minimum distribution is supposed to be $20,000, but you know that you give $5,000 to, let's say, your church or your synagogue every single year like clockwork. You're going to do it. You know you are. And so what you're going to do, instead of just taking receipt of your IRA, your full required minimum distribution, and then writing the check for $5,000 or whatever it is, like $600 a month, maybe that's how you do it, right? If you did that, if you actually took receipt of the money and then wrote the check, then you would have to itemize in order to get that deduction. But since the since the standard deduction is so big now, a lot of people aren't able to itemize or aren't able to contribute enough or donate enough or have enough in mortgage interest when they're retired because they probably got their house almost paid off, if not completely paid off. And so they don't have enough itemizations to really be able to take advantage of their charitable deductions, their charitable contributions, donations, right? And so enter in this required minimum distribution. So now you do not have to itemize in order to get the deduction for this. You just have the company that has your IRA. We use TD Ameritrade, Fidelity. It could be any insurance company that has one of your IRAs as well, and just instruct the company. Usually it's some forms that you might have to fill out to send that money directly to the charity, bypassing you. You don't actually take receipt of it. It just goes straight from the company to the charity. And then you take that documentation into your tax planner or tax advisor, tax CPA, whoever it is that you use to get your taxes done, take that information to them and they'll deduct that. So if you're supposed to get $20,000 for your required minimum distribution and you give $5,000 to whatever church or charity that you contribute to, then how that's going to look on your taxes is it actually is going to look like only $15,000 came out and you're only taxed on 15 rather than the full 20. And you can still get the big standard deduction. So before, if you're contributing $5,000 through checks and you were getting the big, $26,000 deduction, or depending on if you're married, the total with being over 65 and all that, the numbers change depending on your age and filing status. But let's say $26,000 is the amount that you could get from a standard deduction. Well, if you contribute or if you donate $5,000, you're still getting the 26, but you're not getting any deduction on the 5,000. If you do a qualified charitable deduction, you're still getting the $26,000 standard deduction and you're getting the $5,000 charitable deduction as well. And so now that's a $31,000 deduction. So it just makes sense to do that. It's like you're doing the same thing, just in a different way and getting the tax benefit from it. So now, and you can make that, so it's easy to administer. And it's also, you can make it anonymous or not. So if you want the charity or the church to know who is sending that to you, then you can. If not, you don't have to, right? You still will be able to get the deduction for it, even if you do it anonymously, because you'll take the form in that we signed, even though the church may not know that it was you. So that works. Now, I would call this next this next strategy, it's almost like QCD on steroids is how I look at it. Oh, qualified charitable deduction on steroids. It is a donor advised fund. So a donor advised fund, think of that like a savings account for your charitable contributions, or even further, an investment account for your charitable contributions. So what a donor advised fund is, it's a place that you can actually donate money. And then once you donate the money, you control when and where that money gets distributed. So when and what charity that money is going to go to, you determine that. So so when and where. Now, a few things that you need to keep in mind with the donor advised fund. You get the tax deduction in the year that you put the money into the donor advised fund, regardless of when that money actually goes to the charity. So the day you make the move, or if you journal money over from your IRA account to the donor advised fund, the day you do that, that is the year that you will get that deduction. So here's what we do there. Well, before I get ahead of myself. So that gives you the deduction in the current year. The proceeds can be invested and grow. So if you give $10,000 a year, you put $70,000 in there. Well, you got 7 years to get that out. But in those 7 years, there's going to be growth. You can invest that in stocks, bonds, mutual funds, ETFs, index funds, you name it. You can invest that stuff in there. So you could actually have more money to give throughout those 7 years than what you may have originally had if you just, again, wrote the checks. And so that gives you full control over the timing and the amount of the distribution. They are also pretty simple to set up. You don't have to worry about getting a foundation set up or anything like that, and having the foundation do tax returns or anything like that and administer those. I mean, that can get pretty expensive with fees and stuff. So it's a little easier to administer there. And so you can contribute about 30% of your adjusted gross income if you're giving contributions of non-cash assets. So if you're journaling actual securities over, then you can only do like 30%. But you can do 60% if they're contributions of cash. So those are the 5. We've got Roth conversions, IRA to IUL conversions, tax loss harvesting, QCDs, qualified charitable deductions, and donor advised funds, DAFs. Now, so each one of those strategies is good just by itself. However, when we start to combine those strategies, well, now we can do even more things, more cool things. We can do even more cool things, cooler things. We can do cooler things. I passed English class, but I definitely did not ace it. So if my grammar is incorrect, I apologize to everyone out there that has an English degree. I still speak somewhat redneck. And now, so I'm going to go through a couple different combinations of a couple of these different strategies. And keep in mind, there are a lot more. So if I don't touch on one that may work for you, just understand there's a lot of them out there. And so here's one. Then this is just an easy one. Let's say we do a QCD, qualified charitable deduction, that reduces their income. So now instead of having, so they give $10,000 to their church or different charities, so they get a $10,000 deduction off of their taxes. Well, guess what? Well, let's go ahead and now let's convert that $10,000 to an IRA. And so now it's a wash. So you didn't increase your overall tax liability. You may not have gotten the actual full-on tax deduction for that $10,000, but technically you did, because you got the deduction and then you converted $10,000. So you converted $10,000 into a Roth without paying any additional tax. And insert Roth to, to IUL if you wanted to use that strategy as well. So IRA to IUL, that still works with that same thing. Do a QCD and then convert into the IUL from the IRA. That also works. So there's a couple different strategies right there with the QCD again, but let's put that on steroids. And if we know that we give a certain amount of money every single year to church or charity, and right now doing the QCD, we don't have to itemize. But let's say we want to really make some dents in that that tax deferred bucket. So we've got a lot of money sitting in there in the IRAs, and we want to make sure to get as much of that converted to tax-free as possible, whether that's through Roth conversions or the IRA to IUL, whichever one, doesn't matter. So what we're going to do is we're going to front load those contributions all into 1 year using a donor advised fund. So now we're using donor advised fund and Roth conversions or IRA to IUL conversions. And so we know that, again, let's say the standard deduction is like $26,000. Well, if we're given $10,000 a year, well, let's say we're going to front load this with 7 years of deduction. So we're going to journal $70,000 into the donor advised fund. Now we've got a $70,000 deduction. Well, then let's convert another 70, just simple math here. I know there's a little bit more into this, but let's just say simple math, $70,000 deduction. And now we're going to convert $70,000 IRA to Roth or IRA to IUL. And again, it's a wash. And so we didn't create additional taxes by doing the Roth conversion because we utilized a couple of different tax strategies together in a combo to lower your overall future tax liability and overall lifetime taxes. And so I think I'll just kind of stop on those two right there and just say, yeah, so there are just a few handful of tax strategies that can really work well for the vast majority of everyone out there in retirement. And so if that's some of the, planning that you would like to see, then get a hold of us, because we've seen cases or in instances when we, get different software programs that we've got where, the tax savings over lifetime can be several $100,000. And so it is definitely worth doing. Your taxes are everyone's single biggest expense throughout their entire life. And even unfortunately, when we pass away, Uncle Sam still isn't done with us. Like if we have any IRA balances left, that's still going to get taxed with our kids. And so this is a way of not only lowering our own taxes, could be lowering lifetime taxes, could be lowering generational taxes as well. And so there we go. There are, to recap here, 5 main strategies that almost every single retiree should be utilizing would be Roth conversions or conversions of IRA to IUL, tax loss harvesting, qualified charitable deductions, and donor advised funds. So hopefully that this talk about taxes and ways to actually lower your taxes gets a few of you guys thinking that maybe some of these strategies could work for you so that we can help you lower the amount of tax that goes to Uncle Sam, keep more money in your pocket, therefore keeping more money for you to be able to spend throughout retirement, which means that's less money that you have to pull out of your portfolios because less of it's going to Uncle Sam and more is going to you. So that keeps your portfolio intact longer so it lasts as long as you do and helps give you increased confidence that your retirement's going to be okay. So that's it, guys. Thanks for tuning in, and join us again here next week or the next couple of weeks. I think we're doing these every 2 weeks now for a little while. Just always trying to bring you guys more content to empower you to live the retirement you deserve. Take care.